So for today, my name is Paul Chu, Head of Research for Singapore. So for today, we're just going to discuss our Singapore third quarter strategy. And the title of the report is basically slower for longer, because what we think, at least the macro framework, is that interest rates will be higher for longer because it's core inflation, or inflation is going to be hard to kind of suppress to at least meet the central bank's target. In the spirit of generative AI, so I went to Bing image creator, and then so I just typed out, bear riding on a roller coaster. So this is the picture you get. So why we say bear is basically we are a bit more defensive. We have a defensive posture to the market because we see economic growth slowing down. But at the same time, the price action for the market is different. I think we are beginning to see some melt up, at least in the US markets. So that's why we came up with this picture. I didn't create it, not so imaginative, but just to give you a sense of what kind of images you can get from converting just text to pictures. Next slide. So our usual disclaimer, I know I repeat this, I don't know, a few hundred times, but I still have to repeat it because, so basically, do seek advice from your financial advisor. We use a lot of public information, which we ourselves can't verify. Singapore said the GDP is so strong, so we can't verify that, but we have to rely on it. So these are the kind of sources, and feel free, these are our own views and so forth, and we may change these views. Next slide. So for our typical agenda, we will just run through what happened second quarter, but we try not to dwell too much. Then we'll talk about the macro trends, how we see current economic conditions. Then we move on to specific comments on sectors, and then our stock picks, and also some of our recent initiations. So we'll spend a bit more time on sectors and stocks for this time. Again, for the performance, in a nutshell, the rabbit is the US market. The other thing is us, Singapore, but next slide. Yeah. Okay, so for the third quarter, Singapore market was down, I think 1.4, 1.6%. So then we will look at the key index components, and we just want to get a flavor, who did well, who didn't do well. So the banks didn't do well, even though there was record profits. One of the reasons we think is that market views the banks to be over-earning. I mean, we don't think so, but that's what the view that the market is. So even though the banks reported record numbers, but the share price keep dropping, even DBS announced they're going to raise dividends, the share price will still weaken. So one of the reasons is we think the market believes the banks might be over-earning on their net interest. OCBC, you see that it tends to be performing better because we think they have they did a smarter thing. What they did was, instead of announcing special dividend, they announced very high ordinary dividend. So they're giving you a base of at least 5.5. And when your dividend is high, you can defend the stock. When you give a special dividend, just a one-off thing, after the special dividend, everybody sells and then and then this goes home. So that's why OCBC maintained a high dividend, and I think Glenn, our banking analyst, will maybe elaborate more. What did well was, of course, Sembcorp on expectations of higher electricity prices, so high that the authorities say you cannot charge so high. Imagine how high it has gone up. And then, of course, Jiang Zhijiang did all that performance in just 1 month because they ordered like record order books. SIA, of course, great way to fly because they reported record earnings, but their share price went up, or the banks went down. So REITs returned some of the gains, I think, in part because I think interest rates were rising faster than expected. And of course, some of them also did capital raising exercises like Ascender. So that also depressed the share price. The disappointers, what we mean by cyclical is venture. I think electronics is very subdued now. But one thing, venture can at least defend the dividends. They're paying like 75 cents because they got like 1 billion of cash. And also the disappointers, mainly Genting disappointed. So that's why the share price took a tumble. Next slide. So in terms of the various asset classes that performed, just to give you a flavor, in blue is year to date, that means first half of 23. Not very clear, this is yellow or orange. So anyway, in the yellow box is what was the performance for the second quarter, and this is in US dollar. So actually, in second quarter, the REITs were one of the poorer performers. For the year, the worst performer was commodities. So again, commodities commodities supposed to reflect global growth and how global economies are doing in general. But again, the best performer has been Nasdaq. So one of the reasons, of course, why we think the Nasdaq has performed so well is, of course, we all know the structural bullishness over AI. That's number one. Number two is also most of the performance have been, I think we all heard of this, the key 7 stocks, the key tech stocks that have been driving the performance for Nasdaq. And the second reason is also because a lot of companies like Google and so forth have managed to cut a lot of headcount. So the market has become more optimistic that margins have kind of bottomed out for Google, Facebook, and so forth. We are a bit more familiar with the US because we have a US research team that covers a lot of the tech names. And the third reason is, of course, the labor has been strong. So of course, that kind of the narrative of the US market now is that there's a soft landing and economic conditions are better. So that's why you can see such a huge performance. And most of it is driven by the tech names, the big tech stocks. The performance for gold and bonds, these are ETFs, just for your reference. Next slide. So in terms of Nasdaq, so we took a deeper dive into like what's driving Nasdaq. So usually, as investors, we think higher earnings would drive, but actually most of the gains for Nasdaq came from PE expansion, the PE ratio. So the PE ratio was already 27 times, then the market ran up so much, it went to 36 times, even though earnings was cut. So it's a bit unusual. Usually, you have strong earnings, then the PE. So what it means is that there's a lot more optimism on the market. That means the Nasdaq has been re-rated higher. That means people are willing to pay 36 times. Whereas in contrast for Singapore was the other way around. Even though our earnings per share, you can see it actually was revised upwards by the market, but the share price went down. So there's a lot more negativity. And maybe again, we think, of course, a lot of this is driven by banks. Maybe the market still believes a bit about over-earning. One of the best performers this year has been Japan. It's up about 27, but you can see a lot of it is driven by earnings revisions. Of course, the reopening, I mean, I'm not an expert in Japan, but one of the reasons, I guess, is also the reopening phenomenon. But you can see most of Nasdaq's performance is purely just major re-rating. People just, on part again, AI and so forth. Next slide. So that's it, just a summary, you don't have to delve too much. So we'll just run through what we think some of the key macro things that investors should take note of. Next slide. Okay, so the first one we think is that the inflation target is still far off. So the Fed has a target of 2%. Why this is important, what it means is that we think interest rates are going to be higher for longer, and this is going to press down global growth. Next slide. So anyway, this is a very noisy chart. So this is core inflation. Although headlines is down because energy prices, energy commodity prices are down, goods are down. So that's why you will notice the headlines are down. But the most important, which is where the reserve banks measure, so whether they want to raise rates is all dependent on these charts rather than the headlines. So what we worry about, apart from China, which is the other way around, inflation is coming down and they're actually cutting interest rates very more aggressively. What we do see is that it's very sticky. So if you look at the UK, the green line, inflation continues to rise instead of go down. We'll explain a little bit later. And also the EU in Europe is starting to come off, but again, their target is 2. So now it's still the 6%. Even in the US, although even though the expectations was lower by 0.1, but the market just celebrated and ran with it. So there's a bit of a melt-up phenomenon right now in the US markets. But what we think is that it's going to be very sticky, very hard to bring this down to the 2%, which is, of course, you can see the 2 there. So it's still far off from the target. So this has implications. What it means is that the central banks globally have to keep rates high because core inflation is very tough to bring down. We'll explain later. Next slide. So one of the reasons is, of course, labor. So in general, very simplistically, core inflation really depends on services. And what is the biggest input to services is labor. So even though we had the pandemic, you can see even in Europe, although we always say Europe is slow, you can see the unemployment rate in EU or Europe is even lower than the pre-pandemic. US is already full employment. Japan kept up also coming down. So what it means is that that's why the title, the vibrant labor market, is going to keep services sticky and put pressure on core inflation and also keep the and also keep the labor market strong, which is one of the factors that the central banks will monitor. And this will, in a nutshell, it's just a long way of saying rates are going to be higher for longer. There's another measure that the Fed likes to use, which is labor slack. But I won't go in there. But if anyone wants to ask, but next slide. The other interesting phenomenon we sometimes see on the headlines that the US continues to have very strong jobs growth. But one of the reasons is because, so this orange line you see here is the number of employees on the payroll in the US, like I think it's about 150 million plus. But one of the phenomena is because in the US, during the pandemic, almost 9 million jobs were lost. So even though you see very strong growth, it's just replenishing what has been lost. So it's only in June 2022 that the number of payrolls in the US only went back to pre-pandemic. So because of the huge number of jobs that was lost, it was just replenishing. So it wasn't really growing the jobs. So that's why we think that the jobs growth will be stronger than expected. And most of the job gains that you see in the US, I mean, if you do monitor the market, it comes from education, comes from government, and these are very non-economic sensitive. So why this is important to us, at least, is that this means that labor is going to be very resilient, the labor employment, and this means that the Fed will continue to keep rates higher for longer. Although the upcoming 26th July is like 90% of that they're going to raise. This is not my number. This is what the futures market. So there will be definitely another rate hike coming up on the 26th of July. Okay, next slide. So one other interesting phenomenon, actually this is not, this data, I mean, we collected ourselves, but this is what was highlighted in the BIS the recent annual report, is that you're seeing this phenomena in the UK. It's something interesting, and not going to affect Singapore market, hopefully, but what you're seeing is a lot of, this chart is the number of labor dispute shortages. It's a nicer term, basically strikes, the number of strikes that's happening in the UK. So you can see that it's even as bad as the 1970s. So this is something to monitor because you could spiral out of control. So usually, in general, in economic theory at least, labor force will want to, when inflation rises, you want higher wage to compensate what you lost, right? Because inflation just went up. But if inflation expectations, that means if employees think that inflation is going to remain high, then this will cause a very negative spiral because they want high, then inflation keeps on. So it will keep on spiraling upwards, which is what we saw in the 1970s. Again, this is just for interest sake, because we thought it was interesting. So there's this risk in the UK. That's why there's so many strikes, and this will cause a very vicious cycle. Then inflation will keep on snowballing higher and higher because they want to be compensated for higher risk and higher inflation through higher wages, and that's why you keep on getting huge number of strikes. I mean, thankfully, we don't have it here in this region, or even in the US, apart from actors and writers, I guess. Yeah, next slide. But again, if we don't think inflation is going to perk back up, because but we still think that disinflation, that slower and slower inflation will continue to run because money supply is coming down. So, but again, this is a bit too economic, so I'm just going to skip this. Yeah, next slide. Last few slides for me for trends. The thing that worries us, at least from the macro, is that growth continues to slow. Next slide. So what we see is that we use a lot of US data because US dictates monetary policy. So so you can see that US retail spending continues to slide down sharply. The headlines isn't so bad because motor sales in the US now is skyrocketing. It's like 20%. But normally we take out motor vehicles. That's why it's called X motor vehicles, because motor vehicles are very volatile. It can be up 15, down 15, up 10. So we take that. But the underlying worry we have is that retail spending in the US continues to slide. And even though people expect a recovery, like how much can it recover, especially when you have consumers spending coming down in the US. So that's what worries us about growth globally. Next slide. The other thing is also not only the consumers are cutting back, even the corporates are also pulling back. So this, just to go into the weeds here, this is basically new orders excluding military. This is like what corporates, how much are they spending on machines and durable assets, I mean something that lasts very long, excluding planes too. So we can see that that is also coming off quite steeply. Next slide. The other thing is also the UK, the banks also, because of all the bank failures, you can see that credit is also contracting. So it's always never good. I think we also see this phenomena in Singapore, by the way. So it's not a good sign for the economy if no loans are contracting. A healthy economy, you need loans to grow, but this is also contracting fast, in part because of the bank failures. Next slide. The one thing that also helped the market, so there's a fourth reason why the US market, so even though, as you all noticed, like maybe in March, although all the bank failures that happened, the US market still did very well. So I mean, so I guess nobody asked me, but let me just tell you the answer. But so one of the reasons is because the Federal Reserve has really, behind the scenes, the Federal Reserve has really supported the banks. So this is basically the amount of loans that's given to the banks by the Federal Reserve. In normal years, it's hardly anything because nobody wants to borrow from the Fed. Right? You have the stigma is more expensive. So of course, when the global financial crisis, you saw that the Federal Reserve provided a lot of loans to commercial banks in the US. Then this spiked up recently. So behind the scenes, why the US has done well is because the Federal Reserve have bailed out a lot of banks. A part of it is through FDIC, but in general, just to give you the flavor, why another reason the US, even though they have bank failures, but the equity market can still run because in the global financial crisis, the support was as much as 500 billion, because this is a monthly number. Recently, the peak here was about 300 billion. So what it means that the Federal Reserve supported, that's why the US market also did so well. Next slide. And of course, okay, so we mentioned earlier, corporates are coming down, consumer spending is also coming down. So even exports is also coming down. We usually use Taiwan and Korea because they're the main proxy for electronics. So this is already the 8 to 9 month slippage. Of course, people will be asking, shouldn't this bounce back up, like a ping pong ball or whatever? But the bounce, we worry that the bounce won't be as steep as we saw in 2020, because at that time, pandemic, a lot of spending on goods. We worry that the bounce might more be the 2013, 2014 phenomena. So any rebound in exports will be very modest to us. Next slide. Okay, so anyway, last few slides, then before we move to technicals and sector, which I think will be more interesting. But so we also want to have a quick look at what's happening in Singapore, the conditions. So for Singapore, it continues. We think the slowdown is starting to creep in. Of course, exports is coming down. So this is the blue line is exports and the red line is electronics. So you can see that this is as bad as I wouldn't say global financial crisis, but it's as bad as what happened pre-pandemic. There's a big sharp decline in exports. So this is going to weaken the Singapore economy. And of course, the Nordex is bounced up because it's very volatile, pharma and chemicals. Next slide. And of course, even retail sales is also starting to slide quite sharply. The most recent number, retail sales in Singapore is only up 1%. Retail sales in Singapore is not like a very strong number. Even pre-pandemic, we hardly grew, can't even reach 1%. But what we have just that is coming down, sliding back very fast, and of course this will affect stocks like supermarket, Sheng Siong. For those who want to know what are Singaporeans spending most on now, it's mainly, of course, eating out and apparel. Everyone's refreshing their closet, except me maybe. But okay, next slide. Yeah. Okay, then the other thing, the one area that's very strong now in Singapore is of course tourism. And you can see that number. So even though this is post-opening, you can see that the latest number is the highest so far since the pandemic, 1.12 million. Year on year, the number of tourists is doubled compared to a year ago. And what we hear is when we speak to some of the hotels or hospitality, they are excited because of all these concerts coming up. And they are like equivalent to a F1, oh, sorry, maybe shouldn't say F1, but at least they're equivalent to a major event. So like Taylor Swift could be here 7 days. So if you combine it, it could be as big as a major event. So there's excitement there. Of course, there's also the China reopening phenomena, although that's slower than expected. So we think hospitality is one of the strongest areas, and it's important to Singapore because 5% of our GDP, like you mentioned before, comes from tourism, which is a huge number. And during the pre-pandemic, we had like 20 million, 19 or 20 million tourists, which is huge. Of course, Thailand is 40, but if you look at it from the population stance, tourism is quite a big, important driver for Singapore. Next slide. Okay, one last thing is just the liquidity. So the liquidity in Singapore is huge. So I know it's a very confusing chart, but if you look at the blue line, so this is the US reserves that we have. I mean, that means money coming into Singapore in very layman terms. So you can see that before pre-pandemic, it was about 300 billion. It spiked up to almost 400. Then you see the sudden plunge. It's not because people withdrew a lot of money, but because Some of it, MAS pass it on to you call it reserve management government, but pass it on to GIC and so forth. But if you add all that back, actually the reserves in Singapore could have spiked up to as much as 500 billion. Of course, some of it is double counting a little bit, but we think, so what we were trying to say is that the liquidity that came into Singapore after the pandemic was huge. Just that the reserves you can't really see because some of it was taken out and transferred out. But if you add all that back, it's almost as huge as 500 billion, considering pre-pandemic we were 3. So you'll notice this sharp spike. When the pandemic happened, a lot of liquidity came into Singapore. Didn't go to the equity market, but anyway, they went somewhere. Next slide. Okay, one last one for me, before I hand over to technicals, is that Singapore market, there's a lot of negativity now being priced in the Singapore market. If you look at, so the chart here is basically forward PE. Of course, lower better, but nobody likes to buy low, everybody likes to buy high. But anyway, right now, the valuations now is one of the lowest. Again, sorry to keep repeating, we just think that it's all about the banks. People just don't think that the banks can sustain the earnings. So that's why valuations are like all-time, more like a decade lows. And we do this standard deviation, some maths just to show you the quarter. And that's why we think the Singapore market is attractive in that sense. Okay, I think I will move on next to Zain, he will talk about technicals.
Okay, hi, morning everyone. I'm Zain. I'm the technical analyst for the team. So I cover some of the trading ideas on like Singapore, US, Hong Kong markets. Yeah, so some of the trading ideas will be like on the trade of the day if you read our morning note. Yeah. So without further ado, I'll go on to the technicals. So first up, I'll give an outlook of the Singapore market. So this is the ES3 ETF. So if you're interested to trade in the Singapore the index, so probably not, since it's just sideways for a very long time. So for this ETF, in terms of the chart wise, it's actually forming a lower high into the uptrend support. So you can see this uptrend support line since like 2021 is still holding very well over here, but the rebound has been quite low over here. There's a lower high being formed, and market part in the past quarter has actually just been sideways. So for this quarter, I will expect continue a sideways movement between the 3.1 zone to about 3.3 over here. Yeah. So next up will be our large cap pick. So this one will be Yangzijiang Shipbuilding's holdings. So as you probably have known that this stock has performed quite well recently. So in terms of the chart wise, there's this bullish flag breakout that took place over here. So there's a very good continuation of the bullish momentum since the breakout of this 130 horizontal resistance. Then we just formed this bullish flagpole and consolidation. And recently we just broke above this 150 level as well. So when you take the height of this pole is around 130 to about 150, 20 cents. Projecting on the breakout point, it could potentially reach 170 in the next quarter. So that represents about over 11% upside. Yeah, then possibly could test this main uptrend channel resistance as well over here. So in terms of our mid-cap pick, will be Delphi. So Delphi, some of you may not heard of this, but it's actually a chocolate confectionery in the chocolate confectionery business. Yeah. So for Delphi, overall, when you look at the trend wise this year, has been a very big, strong uptrend over here. So previously back in March to May, there was a period of consolidation in the ascending triangle. We actually broke out. Then currently we are in another phase of consolidation over here. So for this quarter, I think it'll be quite interesting to watch this stock. Potential for a bullish flag breakout that can take place over here. So when you take the height of this flagpole, which is around 111 to about over 140, that's about 33 cents height over here. So if you do break out and project it over here around 132, can bring us a target of possibly 165. So that's quite a, if it hits the target, that will be around 26% upside, quite rewarding. Yeah. So possible to keep a lookout on this stock. Yeah. So that's all from me for technicals. I'll pass on the time to Glenn to talk about banking sector trends.
Hey, thanks so much, Zain. So I'm Glenn. I cover the banking sector, mainly the 3 local banks as well as SGX. So, okay, for the first slide, I think Paul has spoke about a bit about the banks. Oops. So just a brief slide on the interest rates in Singapore compared to the Fed rates. You can see the dark blue line and the light blue line. The dark blue is the Fed rates. Singapore interest rates, the SORA, is actually following it pretty closely. And the last month, it increased in tandem with the Fed rates. And the NIMs, however, that's another worry for the banks. We expect it to stagnate. And if you look at 2023 year end, we forecasted it to still increase by 31 basis points. But this is due to sort of a low base in 2022. But if you look at 2024, we do expect it to sort of continue to lower as the funding costs for the banks start to creep up. So, it will still maintain at this very high level of 2.13% for the banks. So, however, there's a positive for the banks. Moving on to the next slide. Yeah, okay, let me talk a bit about this slide. It's a bit confusing, but this is we use DBS as a proxy for the three banks. So the orange line here is the share price, while the blue line is the net profit of DBS. I think Paul has mentioned a bit about how DBS's share price has been sort of stagnated, but the earnings have kept going up. If you look all the way back to 2013 to the recent years like 2020, the share price follows the net profit quite closely, and it's quite closely pegged to their net profit. However, recently, at least in the last 2 years, you have seen that it's sort of inverse, where the share price is not following their record earnings as closely. And one of these reasons is that maybe they are worried that the loans growth might not be as strong for the banks, and also they are worried that the net interest margins might not hold going into the future. But there's one positive point, and we'll move on to my next slide. And that it will be that the fee income, it will be the main sort of growth driver for the banks moving into this year, the rest of the year, as well as in the next year. So in 2022, you saw a very big dip in the fee income, and that's mainly due to whatever happening in the turmoil, the market turmoil. So there's a very big dip. But if you look at the first quarter of 2023, we saw that they have sort of reversed that decline that continued about 3 to 4 quarters decline. And for the first time, we are seeing that there is a quarter-on-quarter increase, and year-on-year is pretty flat. So for the rest of the year, we do expect the fee income to continue to increase, and for a double-digit increase for full year 2023. And moving on to 2024, we also expect a sort of a high single-digit growth for the banks, and this could add to their earnings while their NIM is sort of stagnating. Moving on to the next slide. Yep, so one of the bigger, I guess, points for the banks would be their loans growth and how are they coping with it. So you look at I drew a red line here at the bottom, and this is to compare how low the loans growth has been. And the point here is during the 08-09 global financial crisis, where it reached the record low. And you can see that recently in 2023, it's going to reach that part. But recently, in the last month or so, we have seen that the loans growth has sort of recovered slowly. And while all other segments have sort of declined, the main positive segment for the loans growth would be the housing sector. So while volumes are dipping slightly, we might expect that the total amount, the net amount might increase. So that's a positive sign for the loans growth. Yep, so that's all I have for the banking sector. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Hi, everyone. I'm Darren. I'm the REIT and property analyst. And so for REITs, we begin by saying that we are overweight. We are technically overweight, mainly because of the economic slowdown, like Paul mentioned earlier. So it's more of a overweight on a relative basis, because we are not overweight saying that we think that there's a lot of capital appreciation and growth in DPU for REITs. So here are some of the reasons why. First of all, it's because of the high interest rates, as we all know. And probably the Fed will increase the rates another 2 times, which is another 50 basis points, roughly 25 and 25. So that's one of the reasons. And I'll talk about other reasons going forward in the next few slides. But for this particular slide, you can see here, the orange line is the 10-year historical average, and that is the average of the yield spread. So this graph actually shows that the dividend yield spread minus the 10-year Singapore government savings bond. So the way you can see it is the 10-year Singapore government savings bond is like a fixed deposit rate or risk-free rate. So this graph shows how much you are being compensated for dividend yield above the risk-free rate. So from this graph, when we see that right now it's trading about a 10-year average. So this means that right now, when you invest in REITs, you are being compensated that the average of the 10 years as compared to if you, let's say, purchase REITs or invest in the REITs last year, like you see 2022, it's at the bottom. So you're only compensated about 100 basis points above the risk-free rate, which is, we do not think that's attractive. But now we think towards the 300 basis point mark, we think that is more attractive. And just the green lines are just the standard deviations. Yeah, next slide, please. So another reason why we think we like REITs, or rather why we like REITs, because as you can see here, this is a valuations scatter plot where the horizontal axis is the dividend yield and the vertical axis is the price to book. So right now you can see a lot of the REITs, right? Is trading around the it's trading around the below 1 times book value. Previously, a lot of the REITs, they were cluttered at around 1 times book, or historically they are trading around their book value. But now you can see it's already dropped. Like a lot of them are trading at about 0.8, 0.9 times book value. So how you can see it is like for REITs, the amount that like okay, so for REITs, if you are trading at 1 time book, it means like you are paying $1 for $1 of assets. But if you are trading at like 0.9 times book, you are paying like 90 cents for $1 of assets. So we think that is cheap. And as you can see on towards the right hand side, the bottom right, that is where the US listed REITs, the US office Singapore listed REITs are trading, like Manulife and Prime. Right now they're trading about 30% yield, and they're trading about 0.4, 0.3 times book value. As we all know, the US market, the US office market is very weak, especially the leasing volumes and the slowdown in tech hiring and the tech office space that's required. We're also seeing a lot of big tech, they are subleasing their space after they realized like they started retrenching people, and they realized that they have too much office space, so they are subleasing it. And from that, there's a lot of demand and a lot of vacancies there. So we think the US market, office market has yet to bottom up. We think probably towards the first half of next year, then we'll start to see a recovery in the US side. So for Manulife and Prime, as well as Capital Pacific, there are some headwinds there for now. And towards the other side, like the top hand side is Parkway Life REIT and Capital DC REIT, where they are trading at 1.5 times book and a lower yield. So that is more expensive. Yeah, so we like those that are trading around the center part, which is below 1 times book value, and around the 6% dividend yield mark. Yeah, next slide, please. Yeah, so this chart is just to remind everyone that high interest rates are capping the DPU upside for the REITs. And how you can see this is basically the importance of having a high hedge ratio. So right now, as you can see for Prime US REIT, for example, if they are not hedged, their DPU will be affected by 8% if interest rates rise by 100%, by 100 basis points. So that is the base rate. But however, they are hedged about 79%. So because of their hedging strategy, they're only affected by 1%. So a lot of the Singapore listed REITs right now, they are trading, their hedging ratio is about 75% on average. So it ranges from 70 to 80%. Yeah, so next slide, please. And this is so this chart rather, it shows two things. This is EFR, which is equity fundraising, and we think this EFR equity fundraising is a near-term headwind because, as you can see, in 2022 there were not much EFRs or equity fundraisings of private placements or right issues in 2022, but in 2023, just in the first half, we already see the dollar amount of the rights issue and private placements or equity fundraising rather, already almost doubled the 2022 amount. First of all, we think this is because a lot of REITs, their gearing levels has increased a lot because of their property devaluation, and they are trying to kind of lower their gearing ratios to below 40%, because that's the MAS regulation is 45%, but if your ICR, the interest coverage ratio, is more than 2.5 times, you can bring it up to 50%. But that's not what all the REITs want. They want to keep it at around 40% or below, because that's a safe level that a lot of investors feel comfortable with. So yeah, because of that, a lot of REITs are also raising funds to lower their gearing, and as well as for acquisition purposes. So like in 2023, we see 4 or 5 after the iREIT one that's just was very recent. So Ascendas Mapletree Industrial, and AIMS APAC, and ESR, they raise funds. And Ascendus and Mapletree Industrial, they raise funds for the acquisition, and the other two is they kind of raise funds for AEIs and just to bring their gearing levels down. So the way you see these private placements, you kind of kill the share price, because when all this influx of shares, when they raise funds right at a cheaper rate, you kind of have a near-term headwind to all these or near-term headwind to the share price, as you kind of dilute the current shareholdings. But in the long term, if let's say they raise funds for accretive acquisitions, it might benefit the REIT. But that's in the longer term. But the near-term headwind is still the dilution of the shares. Next slide, please. Yeah, so this is just to show which subsector of REITs that we favor. Like Paul mentioned earlier, because of the RevPAR recovery and the visitor arrivals that Singapore is experiencing, the increase in visitor arrivals, you can see it's 100% year-on-year, but it's still not yet at pre-COVID levels for visitor arrivals. We think right now China is about 20% the outbound traffic, but the flight capacity from China, it rose from about 11% in January this year to about 50% as of July. So the flight capacity in and out of China has really risen by so much already. And that's one of the potential catalysts that we think that, especially when Chinese return, and this will help to benefit the RevPAR as well. And right now, as you can see, the RevPAR is also above pre-COVID levels and is still growing at 34% year-on-year. And for Singapore, especially like the F1, like Paul mentioned, and all the major concerts from the mega stars like Coldplay and Taylor Swift. So this, the F1 last year, there were about 302,000 people who attended, and we expect these similar amounts for both Coldplay and Taylor Swift. But we expect Taylor Swift to have more foreign demand, because Taylor Swift is the only stop. Like Taylor Swift only stop for concert is in Southeast Asia, is in Singapore. Yeah, while Coldplay, there's some stops around Southeast Asia. So because of that, there's a lot of foreign demand. And you just do some quick maths. Let's say 30% of 300K, which is the total now of six nights, costs 50,000 estimated capacity for each night. So if you counter that, about just 30% of the 300K is about 100K foreign demand, and this 100K we have to find lodging. So yeah, because of that, we also see a lot of the hotel bookings and the demand like searched by about 8 times. There are some news reports saying that. Yeah, so all this will help to keep the RevPAR up and probably increase even further going forward in the next year. Yeah, next slide, please. Yeah, so moving on to property. So as you all know, property, we are neutral on property because of the cooling measures. The most recent one was the one in April, where they rose the ABSD for foreign buyers from 30 to 60%. Yeah, so one trend we notice is that all these cooling measures, they are affecting mainly foreign buyers and not so much the first-time home owners. So those developers with luxurious properties, like for example CDL, their Newport residential cost, that was the target audience for that was more of foreigners and the luxury high end. But then they carry on with the Mist, which was more of targeting local buyers. So yeah, and this chart rather, it shows the residential government land sales. Like in the second half of 2023, we see that the residential supply that was released is the highest since 2014, and the skew is more from the confirmed list, which is in the blue line. So this complements the fact that the government is trying to cool the property prices, and property prices has risen so much over the past 3 years. Yeah, next slide, I have a graph which shows the property price index. Yeah, so this is the residential property price index, and as you can see, it's at 194, but it actually dipped 0.4 basis points in the most recent second quarter. And we think this is probably because of the ABSD, and we expect the property price to moderate as well going forward because of this cooling measure, and as well as the government land sales, that the more supply rather. So we expect the property prices to moderate going forward. And one trend that we noted here is that every time the property price increase double digit, like 10%, then there will be cooling measures. So you can see like the past two times in 2021 and 2020, the property price rose by about 10%. Then there was a cooling measure like in December 21, they raised ABSD after 10.6%, and in April again they rose the ABSD after 11.4% rise in property price. Yeah, next slide, please. Yeah, so this is just the new launches, property new launches year to date. Gone are the days, especially last year. Last year there was about 4,500 new launches, and this year we expect about a double or slightly more, from a double of the new launches supply. Yeah, and because last year was only 45, a lot of the high demand, and because of that, a lot of the new launches, they kind of sold out within the weekend. But we do not see that happening again going forward this year. As you can see, a lot of it, the take-up rate is there. For some of the projects, like the Mist is 27%. Yeah, so we do not see those fully take-up rates like over the weekend going forward. So we think the property, that's why we are neutral on property. Yeah, that's all for me. I hand over time to Peggy. Thanks.
Darren. Morning, everyone. Thank you for coming today. I'm Peggy Mark. I cover the conglomerates and transport sector. But I'm talking about construction now. Okay. This construction sector in the last 38 years, in my memory, is always called the pump primer, because when the economy is down, especially if we have an election next year, construction will come out and become the stuntman for the whole economy. They will pump out a lot of new projects, allocate a lot of new projects, especially from the government sector, public sector, so that to make sure that we're still humming with activities. So for this, in line with what Paul has mentioned, that we think we will slower for longer for the second half of this year, the construction will play a bigger role in the second half of this year in terms of amount of work being done. So the first 5 months of this year, construction was very slow in terms of work done, mainly because we have these heightened safety measures. We have quite a number of fatalities in the construction sector. So they asked the work sites, please check your safety rules and make sure the workers are safe. So from June onwards, the construction activities has picked up again. This is the construction awards numbers. Awards typically get translated into work done 12 months down the road. So it's a leading indicator for us to see how the sector will do well in the second half of this year and the next year. So we see that over the first 5 months of this year, the awards has been roughly about flat compared to last year. And last year was already a decline from the year before. So for the rest of this year, maybe progress activities will be slow, but the ramp up will be very strong for second half for 2024. So we are neutral in the 6 months horizon, but very strong uptick maybe from 2024 onwards. Now, if you see, when you hear about contractors getting awards with more very strong orders and sitting on very big order books, maybe not so much to be happy about, because contractors face certain pressures. Firstly, the labor cost has gone up sharply for them, and the dorms, there's not enough space in the dormitories. And second thing is, next year the labor levy, the structure will change. 1 locals to 7 foreigners now will change to 1 to 5 next year. So they can only employ lesser foreign workers compared to now. The second thing is the contracts are bigger now. Also, in line with the higher property prices, contracts are bigger, and especially if the contracts are longer, there's a risk of building materials price overrun, right? When the price shoot up, or the credit risk as well. Because if you take on the contract, you have to put on performance guarantee and so on. So there's a cost incurred that will eat into your margin. So we're not so keen on the construction sector, so we have a neutral call. But to play this sector, maybe it's good to get into the building materials players like Pan United or BRC, where the prices are monitored by BCA, and they get paid very quickly. As soon as the work is certified done, they get paid within 21 days. So there's our view for construction sector. I move on to the conglomerates. Okay, the word conglomerates is very misleading. The Singapore conglomerates, if you look at Sembcorp and Keppel Corp, they are actually energy and property, right? So there are two stocks actually, they move in line with the oil price. So and most of their earnings are actually generated from the energy sale in Singapore. Then the property part of that gives the exceptional profit if they manage to sell. If they don't sell anything, there's no income from property sale. So for Sembcorp, is a play on the Vietnam market for property, and for Keppel, China is a bigger part of the property component. So this chart here is the uniform Singapore energy price. This is the wholesale price, which is the price that the Sembcorp and Keppel, the price that they capture. It's not the retail price. It's not the price that you pay at our electricity tariff, because it get passed through to SP, and then it gets to us. But this, you can see the first half of this year, we think that the Keppel and Sembcorp might report a decline in year-on-year profit, because last year February, they had an exceptional gain from when the war erupted, the energy prices shot up. So then that time they had spare capacity, so they were able to capture the gain from the spot market. So there was some exceptional profit last year. But this year, the year-on-year numbers are lower now, except for the month of May, when energy prices shot up temporarily, and then the TPC come in, the temporary price mechanism that the EMA introduced kick in, and that applies from July this year. So from here onwards, there's no exceptional gain for the two conglomerates. So we think that the earnings, any upside, will only have to be captured if they able to sell any of the property assets. So we have a buy for the two, because we feel that both of them are still trading at below the RNAV, and the RNAV component, a lot of it is the value of the properties, which are all stated at book value and currently in their share price and in their net assets. That's all for me for now. I pass it on to.
Thanks. My name is Paul. I cover all the sector that nobody want to cover. So okay. So the first one is semiconductor. When we talk about semiconductor in Singapore, so just to refresh, it's mainly only 3 stocks. I mean, it sounds like a lot, but it's mainly UMS, AEM, and of course Franken, and most of it very dependent on semiconductor equipment. So that's why we have this foundry capex. Foundry basically means it's companies like TSMC that actually make the semiconductor. So you look at someone like Nvidia, so they're not going to waste capex on building a factory, and so they will outsource it to TSMC. So this is a chart of their capex, like Intel, and this will all benefit companies that we mentioned, because they will make the equipment that will be sold to all these foundries. So you can see that when the pandemic happened, when everybody started to buy a lot of goods PCs, so you see this big spike is almost doubled. So it's a phenomenal run in capex, which is 77 billion to 135. But we think if you move into 2023, there's a big drop. So that's why we see this weakness across all the 3 semicons. The expectations is 2024, there should be a rebound. So we still think that the third quarter results will still be weak. So the title is cyclical weak, but we also wanted to change it to waiting to re-enter. So why we think it's healthy structurally is because the supply chain is getting more ingrained into Southeast Asia. So most of the 3 companies that we mentioned actually have a lot of new customers, new projects, some medical, some semicon, because most of the supply chain coming to Southeast Asia. But the problem is that demand is so weak, so you cannot launch any new products when demand is so weak. So we think that they will push out to 2024, and we should see a rebound even better than that, because not only should you get a bounce, but because you're going to get new customers, so you will bounce better than the 113 to 119, isn't much, but you'll get a stronger bounce because you got new customers as they move a lot of the supply chain, like applied materials, has started opened a new factory in Singapore. So this will benefit the supply chain. So we think it's just a matter of timing for us. So that's why we have neutral. And we cannot, for us analysts, we get blamed. Cannot be too early. Too early also wrong. Also must get it right, and the timing also must get it right. So we just try our best to do it. Next slide. So the next one is telco. The title and the chart doesn't coincide, but I'll just tell you there's two stories here. So for telco, when we say telco, everybody's like shut off, which understandably, because penetration rate is already 180%. So who's going to buy any more phones? But most of the upside we think for telcos will come from the non-telco business. So if you look at like StarHub, so for StarHub this year it's going to be a tough year because they are spending 200-300 million to improve on the IT system, to also and spend a bit on EPL. I'm not sure why, but hidden inside StarHub there's a very strong cybersecurity business. But as an analyst, most of us won't put any valuations there because the profit is quite marginal, and they don't really put a lot of hit like that. But we think beneath that there's a big cybersecurity business, which if that gets a re-rating next year, when they flush out most of this spending to improve on their IT, then it might look like a more interesting story together with possible consolidation. For Singtel, so Singtel also, when we say non-core, because Singtel also wants to become like a capital corp. Just sell things, sell furniture, sell everything, and then your share price go up. Who doesn't want to do that? So Singtel also wants to sell. So they want to sell not sell, but they want to redevelop the comm center. They want to sell stakes in some of their data centers, submarine cables. So that's where we think in 2024 too, that could be the potential. And there's also another big data center coming up to be turned on by Singtel in next year and the year after. And this will be immediately accretive because once you turn on data center, you just all profit coming in because it's all fully leased out. The only issue for Singtel is the Optus. So for this chart, you'll see the capex, so cumulative capex. So this is the amount of spending to build towers and that Optus has spent since 2017. So they spend from 2017 to now cumulative. That means it's about 10 billion, and the profit is only 50 million. So I also want to be a management since the demand is not so high. So since the benchmark isn't that great, but in Optus, the ROE is in less than 1%. So this is the hidden thing, which if they can turn that around, then that would also can re-rate the stock because the ROE now is only less than 1%. So it's not good to be a shareholder of Optus, but maybe it's good to work there since the benchmark is so low. But one thing we can say is that in Australia, mobile prices is rising. So that is another tailwind for them, hopefully. Yeah. Next slide. Okay, so for palm oil, we don't cover, but because we always get questions on palm oil. So this chart here is basically production. When production rises, of course, the price will come down. And the red line is the palm oil price. So at the peak last year, palm oil exceeded in ringgit. Normally we talk palm oil or ringgit. It's slightly above 8,000. But having spoken to some of the palm oil companies, so recently there was a big bounce. So first half, palm oil has been weak because a lot of the rapeseed, everyone thought Ukraine wouldn't be supplying any rapeseed, but a lot of supply came in the inventory. So that kind of pressed down prices and also soybean. So what has happened is that there was a nice bounce recently in palm oil price, almost by 20%. But we think because the results are going to be quite poor, because last year you got 8,000, now your palm oil price 3,000, obviously your earnings going to collapse. But why the title says that we are waiting for El Nino optionality. I mean, nobody can tell the weather. As good. Everyone is as good as me. Let's look up. And so nobody can predict the weather. But if the share price really dwindles down, it might look interesting because you might buying some optionality in El Nino. So El Nino means the weather is very hot. And what happens is that the trees will get stressed, the fruits cannot form, and then the production will be very weak. And the worst scenario is the good and bad to it. The best time where palm oil prices will be the highest is when the worst of it, which is basically when we get haze here. So once you see haze, means the palm oil price is going to spike out. So you'll know what to do if you get a lot of haze here. Because when there's haze in Indonesia, what it means that you cannot harvest there's no clouds, there's nothing. So the production will collapse. So what it means it'll be very severe El Nino. Of course, El Nino doesn't only need to be here, it has to also be in the US. Because if soybean production is a lot, then it won't push up. So, but what we think that could be an interesting thing is that there's optionality if the share price is big. So again, but because weather, nobody knows. Nobody can predict that. Next slide. So the other one which I cover also is healthcare. So for healthcare, so the conditions right now is that, okay, let me just start. So healthcare, the main stock is actually Raffles Medical. So Raffles Medical did very well in 2022. It beat my forecast by actually 100%. So either I'm a very poor forecaster or actually a very poor forecaster. But anyway, why Raffles Medical did so well? Because we thought when the pandemic was over, the earnings would drop. But what has happened is that there has been a huge bed crunch in the public hospitals. You won't really see this number. So this is admissions. That means the number of people. In a way, not nice to say, but the number of sick people actually, but I shouldn't say that, but actually it's number of admissions into the public hospitals. But the problem is that as the authorities raise the number of beds, acute hospital, and this is very expensive. When you have an acute hospital, you have operating theater, you need specialists. But no matter how much you raise, the demand, the number of admissions continue to rise. If you do a rough ratio, it's about 50. There's like 50 admissions per bed. Although you don't notice it came down here, but the other problem is, apart from the aging population, is the length of stay. So the length of stay has really increased. We don't have the exact data, but it could be almost doubled. So as a result of that, what the authorities did was they set up this transitional care facility. It's like a hospital, mini-me, shrink down version. But that helped a lot of the hospitals here. Can be Thomson Medical, can be Raffles Medical. So because of that, all these companies or healthcare companies, they almost got like overnight, they had a new hospital to operate. So that's why the earnings went up better than beat my expectations by 100% of so that, and of course the GPs also did very well because there was a lot of vaccination, immunization. These are very high margins. And also but what we worry is that now that the pandemic is over, the margins on the TCF, transitional care facility, will come up. So we are a bit more neutral on the healthcare sector. Next slide. Okay, the last one for me before we move on to stock picks is consumer. So consumer, what we took was the wage of, you can't really see there, but basically it is Vietnam, Thailand, because for Singapore, we are interested in Thailand because Thai BEV, Thai consumer, Vietnamese consumer. And then for Indonesia, because of Jardine, we are interested in the Indonesian consumer. So the ASEAN consumer has been hit pretty hard because you can see which, because of the economy has been weak. And that's one of the reasons. But we think there could be a recovery, as the reopening happens, and also there's a bit more pro-labor policies as they raise minimum wage and new governments coming to stimulate. Okay, so that's why we're over it. Next slide. So we'll move on to some of our stock picks. We'll usually talk about our usual model portfolio, but we'll also talk about some of the recent initiations that we did, like SIA, sets, and so on. So anyway, this is our model portfolio just for your reference. We took out DBS since they were such a poor performer, and then we added Thai BEV. We'll explain later. What hurt us the most for our model was property. Property hit us very poorly, like Capital Land and CDL, because of the cooling measures. It didn't really hurt Propnex, but in CDL and ComfortDelGro CDL and Capital Land was hurt pretty badly for property. Capital Land investment is more for China because there was optimism in China, but now that the expectations has weakened, that's why Capital Land has been affected. Next slide. Again, this is just a reflection, this illustration. You may or may not repeat because ours is like we have 10 stocks, 10% allocation. That's for ease of computation, and that's the performance and so forth. So property and China derated. Next slide. So the first one we're going to talk is just on Thai BEV. So why we think it's interesting, because if you look at this chart, this is the PE ratio and share price. So the PE ratio right now is about 12 times, which is actually even lower than pre-pandemic. So for us, we thought so why the valuations are so low? So one of the reasons is mainly because of the new, potentially new government introducing a alcohol bill that will liberalize, invite more competition. But we are a bit more skeptical on competition because they have 90% share of the spirits. So anyone come in will be subscale. Like how many, they have like 10,000 distribution points. You can't replicate them. And even if you do well, they'll just take you out. So we are not so worried about the competition, although the market, and of course there's also politics and so forth. But even in Thailand, some of the PE consumer stocks are trading like 20 times plus PE. But Thai Bev has kind of decelerated quite sharply by to 11, 12 times. The other reason is Vietnam is doing very poorly because the macro conditions in Vietnam is exceptionally weak. So that's why the share price is down. The only tail risk, which I mean no one can predict, is that if there's the whole Thailand, because of if there's protests and there's a violent protest, then of course that is the only bet that we cut that you are making here, that because if whoever government comes in, it will still be status quo, the economy will still run. It's just that if that is your risk that you're taking, that is the bet or risk that you're taking. If worst case scenario, something happens there. Although when we do speak to some that monitor Thailand, they do say that the authorities there has a better handle because it has happened before. There have been protests the last few years, but they've been better able to manage. But again, that is the risk that you're taking if you do go into this is the political tail risk of violent protests and so forth. Next slide. Okay, so this one will be like, okay, so this stock has been the longest in my model portfolio. So I've been trying to understand. So when we added in was in fourth quarter 20, when the share price was about 140, then it went to 170, now it's back to 120. So as to why this has performed poorly, so I started to learn feng shui and I blame it on the furniture, but that's not the reason. Okay, what has caught us off guard is that number one was mainly inflation really hurt this stock really badly. So for Comfort, the UK operations did very badly because all the bus drivers, like I told you, there's a lot of strikes in the UK. So they had to reprice, they had to pay all the bus drivers higher. And as a result, that you only get the repricing in a year's time. But anyway, let me just get back to the thesis. Firstly, why we had liked it is because pre-pandemic, at 2019, ComfortDelGro's net cash was about 70 million. Right now, it's about 700 million. Because throughout the pandemic, they were profitable thanks to the authorities. But anyway, and also because their depreciation is 300 million. So this company generates a lot of cash. They are starting to buy back shares recently when it came out. So, but the outlook we still think is positive. It's mainly because of taxis. Yeah, I know taxis, very strange to say taxis is the positive. So one thing is that if you look at this chart, ComfortDelGro's taxi fleet has been collapsing. Of course, we all know why. A lot of it went to ride hailing. But we're starting to see some stability and a bit of improvement. We're not expecting taxi fleet to grow, but we're expecting at least to stabilize. So that's the first positive. The second thing is, last year they were still giving out rebates, basically discounts to taxi drivers about 15%. So from second half onwards, I think they cut it back to, second quarter onwards, they cut it back to by 15 to 10%. Of course, I mean, we did ask them, wouldn't they be very vocal and complain? But it wasn't. So I guess the taxi takings have definitely improved. Another one is they're raising the platform fee. And the third thing is that there's a bit of a change in ComfortDelGro. They are pushing more towards the app because that is the behavior now. And they're starting to charge like commissions, like they raise the commissions and they also impose platform fees. So that's why we think the outlook is better. And in the background, because of what happened in the public transport, so they got the bus business too. The bus business in Singapore, it didn't do well because they had the recontracting. But anyway, we think that as the year goes on, most likely in the third, fourth quarter, you will see a big jump up in the UK earnings because they will go to the authorities and ask for higher because it's pegged to inflation. How it works is that their model is just, like I told you before, they just drive around and around, and they're not supposed to take passenger risks, but the authorities will pay them higher when the inflation rate is higher. That's how the contracts are designed. Next slide. So this is my last one for me. Hopefully you all didn't see the second quarter slides because this is exactly the same. So I didn't know what to change. I usually try to change my slide, but basically we think Propnex is still attractive, 7% yield. Of course, the volumes and earnings might have to peter down a little bit because the launches will not be as vibrant, especially for the high end. But the number of launches is still going to double from last year. So last year was 4,000. So this year would be 8 or even 9,000. So that will still support, and they're paying a 7% yield. They can defend this yield because to pay off this yield, they have to pay like 40-50 million of earnings, which they normally generate that a year, and they have like 150 million of cash. So they can still pay that. The only thing is just the earnings. We're not sure because they only do 6 months. So the earnings momentum may not be that strong because the volumes, because of the cooling measure, some of the launches were delayed and so forth. But this is the last one I have. I think I'll hand it over to Glenn. Thanks.
Hey, thanks, Paul. Yep, so our pick for the banks it will be OCBC. And I think the main reason why we are doing this, if you compare all three banks, they do have the same selling points, mainly higher NIMs, which are increasing their net interest income, and also the fee income recovery, and as well as so these 2 points are the main selling points for the banks. However, how do we differentiate our pick, OCBC? I think the main point would be that their dividend yield is extremely high, and this is mainly, and they also have a very high CET1. So their CET1 is the highest amongst all three banks. If you compare to the other two, there are two peers, DBS and UOB. They have recently acquired their Citibank assets, and that's why their CET1 isn't as high. However, OCBC has not really come out to say anything about acquisitions, or even in their most recent sort of presentation, and they did not really say that they're going to increase their dividends. But we do expect that they will steadily increase their dividends to reach their optimal CET1 of 12.5 to 13.5%. So we are forecasting that in 2023, that it will be around maybe 6%. Currently, their dividend yield is 5.5%. It's the highest amongst the three local banks. The rest are all below 5%. And even in 2024, it could go reach just below 7%. And one more selling point for OCBC would be, they just recently announced about a week or half ago, during their media conference, where they mentioned that I think they want to change their brand logo. Maybe they also consulted some feng shui, I'm not very sure. So I think the second thing that is more important is that they announced that there will be a 3 billion revenue boost from Greater China in incremental revenue increase over the next 3 years. But they didn't really mention much about how is it going to affect the ROE, or where is this going to be front loaded or end loaded. So I think we have to wait. They said to wait until the next quarter's results. So I guess when the results come out, then I'll have more information to share for OCBC. Okay, now moving on to my next counter would be SGX. So SGX, I would say the worry for some people would be their volumes are sort of dipping, and this is not mainly to their fault. They are trying their best, but I think it's due to the market sentiments where you see their equity and derivatives volumes are declining steadily. But I think one point that most people don't really focus on would be their treasury income. So I've put this chart up here of their collateral balances. So let me explain what collateral balances are. Basically, whenever you have cash with SGX, they're required to hold a sort of a portion of this with them. So they have large amounts of collateral balances. If you look at the chart here, it's been steadily increasing, and I think currently they have about just under 14 billion worth of collateral balances. So how do they earn interest from this? I think they do it like what we would do as well. They'll put in the most secure deposits in fixed deposits. So it's not very long-term, short-term. However, so they will earn interest from this. And how does this affect them? So in a high interest rate environment, in a low interest rate environment, firstly, they will definitely be affected because they're earning very low interest from this. But now we are in a higher interest rate environment, and we can see that their treasury income is starting to increase. If you look all the way back to, let's say, 2020, this was the peak of their treasury income when interest rates were high, but it dipped severely in 2021 and 2022, mainly due to the low interest rate environment. So now we are sort of surpassing the high interest rate environment, and we do expect that this treasury income will be boosted, and it might even surpass the previous levels reached in 2020. So for some perspective, you look in the first half of 23, they announced that they have 73 million of treasury income, and this is really above the full year 22 49 million. And we believe that you could even triple full year 22. So this could add around 10 to 20 percentage points to their earnings from this, just solely from treasury income. So I think that's all I have for my stock picks. I'll now hand it over to Darren. Thank you.
Yeah, thanks, Glenn. Yeah, so for stock picks for REITs, we have CapitaLand and Scott Trust. So the story is that there's a RevPAR recovery will continue to grow. As you can see, it's been an upward trend since COVID. And right now, in the first quarter, it's at 127, and it's about almost double from first quarter of 22. And we expect the first quarter of next year to be very strong, especially from the Coldplay and Taylor Swift concert. So usually the first quarter is seasonally weaker, but next year's first quarter will be very strong. And for Escort, right now, the recovery we think is from China, because China, historically about 9% of their Escort's clients are from China, but in the most recent quarter and the most recent last year, which was FY22, only 3% of their total clients are from China. So when this recovers back to probably about 10%, which is their historical average or historical norm, then this will help to benefit the RevPAR as well. And right now, historically for China as well, it used to contribute about 10% of their revenue, but only contributed about 2% last year. And Vietnam as well. Vietnam also used to contribute about 9%, but only contributed about 5%. So the recovery play and the benefit and the RevPAR growth we think will be from these two countries, China and Vietnam, because the other countries like Singapore, Japan, US, etc., all these are their ADRs, which is the average daily rates. They are already above pre-COVID levels. And we think we can maintain there, but it's hard to grow so much, like hard to have those triple-digit, double-digit growth going forward, because it's already reached pre-COVID levels and it's already it's quite high. So we think the recovery in RevPAR going forward will be from the growth in occupancy, or rather the improvement in occupancy. So that's the main reason for Escort. And Escort right now is trading at a forward FY23 estimated DPU of 5.8%, and which is our strategy to invest in dividend-paying stocks. And Escort, furthermore, they also have about 300 billion of divestment gains that they've yet to distribute in the books. So let's say for going forward, if bearing any unforeseen circumstances where the market is not doing well, and let's say the interest rate rise and the DPU from operations drop, they could possibly pay out a portion of this 300 million to kind of maintain their DPU going forward. Yeah, so next slide, please. Yeah, so for Phillip Centrepoint Trust, the story here is that they have very stable operating metrics. So as we said previously, we think that the DPU, the growth in share price, we think it's quite challenging for REITs to grow their share price in the current high interest rate environment, and it's hard for them to grow their DPU as well. But for FCT, we like them because their occupancy has reached an all-time high of 99.2%. And right now, we see that their tenancy is also averaging at about 5 to 10% above pre-COVID levels. And we think this will maintain going forward. But we do note that the retail sales might slow. But having said that, we still think that FCTs, because of their operations, they're very stable. And furthermore, they've already refinanced their FY23 loans that are, I mean, they've already secured their refinancing for all the loans that are expiring this year. But we think the rate will be at about above 4%. So this will also hurt them. But overall, we still think, we still like FCT because of their stable operating measures and the high retail occupancy of 99.2%. Yes, and with their stable DPU of 5.6%. Yeah, next slide, please. Yeah, so for city developments, we all know that they are hurt quite heavily by the cooling measures. As of April, they were supposed to launch their Newport residences, but because of the cooling measures that it kind of was announced like a few days before their scheduled launch for Newport, they delayed the launch, because Newport is mainly for their target audience is the target customer is rather high-end foreigners, because the property is pretty luxurious. So because of that, they delayed it, and they continued with their launch of the Mist. The Mist was or rather is targeting kind of the local buyers, and it's kind of a mid-tier development. So because of that, because of the ABSD that was targeting the foreigners rather, and not so much of the local buyers, they continued with that, and we saw a 27% take-up rate in for the Mist. So this chart is another segment of their business. This is the hospitality segment, where it contributes. They have about 30% of the assets in hospitality, and as usual, as expected, we see that their RevPAR is growing. So year on year is grown 65%. So this hospitality segment is also one of the segments is a standout for CDL in the weaker property development side. And one more thing is that they have a lot of commercial assets in the UK. Like recently in the first quarter, they acquired St. Catherine Docks in the UK. So that brought their AUM for commercial assets in the UK to above £1 billion. So this one UK asset, they could monetize it by perhaps putting into a REIT structure, REIT structure. Like they tried to do something similar last year, but it kind of fell through because of the high interest rates and the weak market. But this could be a factor for them to monetize their UK commercial assets. And another thing for them is right now they are pivoting to more of a recurring stream income, where they have this new thing called the private rented sector, the PRS, where they acquired some land in Leeds that they will develop to build, and then with the intention of renting out rather than to sell it as a developmental property. And they also have acquired some PBSAs. So all these are kind of the recurring income streams that they are looking to pivot into in the weaker property market. And property development market. So right now we have accumulate for CDL, and this target price of $8.33 is at about a 45% discount to our RNAV of about $15. Right now, the share price of CDL is trading about 55% discount to RNAV, and this is, if you compare it to the REITs, like for REITs, a lot of them are traded about 1x book. So CDL, if you take it into consideration, is traded about 50 times a discount to the book. Yeah, next slide, please. So for CLI, the story is really the recurring income streams. So as you can see in this graph, FRB is a fee-related income, which is the fee that they generate from managing their lodging assets and managing their listed and private assets, like the subsidiary, the listed like Escort and Sanders. So that's the management fee that they get under the FRB fee-related business, and it's very sticky because all this is very stable income. And the other segment is the REIB, is their investment management, is rather their investment business like in China. So like Paul mentioned previously, China was quite heavy in their profit. It used to contribute about 30%, but because of the weaker environment, it contributed only about 10% last year. So we understand that the China market is weakening, and like the rental reversions for most of the assets, like commercial assets and retail, are looking to be negative, but the only positive is the new economy assets that are having positive rental reversions. So the China market is still weak there, but we like CLI because of really the fee, the stable recurring income stream that they have from the fee income business. And but one thing to know is that because of the high interest rate environment, they are also hit because it's hard for them to raise funds to increase their AUM and to increase their fee-related income, because the fee-related income, a lot of it is from the AUM. They get a percentage of the fees from the assets under management. But because of the high interest rate environment, it's hard for them to raise this AUM. They have a target of 100 billion. Right now it's about 89. Yeah, so these are the reasons why we like CLI. Yeah, so that's all for me. I hand over to Peggy.
Thank you, Darren. Okay, talk a bit about Keppel, why we think it's a buy at the moment. Our target price is $7.01. This is our RNAV valuation. What what you see in the markets right now, there's some target price of $9 because they imputed development profits into the land bank, which I have not taken into account, because it really depends on when they sell this land, and they don't develop them, they just sell the land as it is. Yeah. So this is how I arrive. What is the breakdown of my RNAV for Keppel Corp? The asset management portion is the one that comprises some of they own 4 listed REITs in Singapore. So there's inside the 38%, there's some of the value of the REITs, and REITs has been not doing well. So this share of the pie is shrunk compared to last year. So we like to buy things when they are cold and then sell when they're hot. So we think that this share of this portion of the pie should grow when REITs valuation come back. So Keppel will be a big winner in this REIT recovery. The other thing is Keppel as a whole is converting from become an asset owner to be a manager. They want to be a mini-me capital land investments. So they are actually trying to increase their asset management portion so that they generate recurring fee income instead of in the past when they sell assets and then try to book exceptional gains from sale. So therefore, going forward, we see this. I'm not sure what color is that, but the asset management pie will grow bigger, and when with the recurring income, we think that Keppel should be related based on a PE basis instead of currently at the RNAV, where we always put a discount to it because of the holding company factor. So along the way, we see a strength in the appreciation in the value of the Keppel Corp. Okay. Yeah, so maybe I follow on to the next segment where we talk about recent initiations. Okay, two are mine. I haven't booked a flight since I wrote this report, so I'm not sure whether they will bump me out or not. But I called a reduce on Singapore Airlines, and after that I had a lot of questions. So yeah, the main reason for that is that if you look at this yield, this is the yield number that we monitor passenger use. Use is the value that SIA earns from every passenger times the kilometers that the airplane flies. So from this table, you can tell that the yield has actually hit a record level in FY23. Okay, 24, 25, maybe you ask, hey, there's not very much decline, right? But actually, most of these 24, 25, the yield comes from the budget airline. Well, in terms of my forecast, it's on the budget portion. Budget airline, the yield is high, but you don't make as much money because the cost for budget airlines is also relatively higher. So the margin for budget side is actually lower. So for passenger use, it has hit record level. We think it should fall, especially when the regional airlines like Thai Airways, the Emirates are very aggressive. And all your Cathay Pacific is all coming back up very quickly. Cathay Pacific for the first 5 months, the passenger number is already 118% higher than the whole of last year. So when all these airlines start to put in their flights, put back their capacity, the SIA will not be able to charge that kind of cutthroat rates that we are all paying right now. So we think the fares should come down. And the cargo side is very weak. It's weaker going forward, mainly because the demand is not there, manufacturing output is down. The other thing is that in terms of maritime, the competition comes, the air cargoes come from the sea cargo. So if the sea is cheaper, the shippers will send it through the sea. And now sea cargoes, the freight rates is just about single digit higher than pre-pandemic. Whereas air cargo, the freight rates is still about 40% higher than pre-pandemic. So if you can, your cargo can go on the ship, then I mean, they will choose the ship route. So therefore, the demand for air cargo will drop. So with all this, with these two, especially, and also there are other factors like, for instance, they just redeemed the MCB. They had another 3.1 billion worth of MCB to redeem, and all this redemption will bring down the net asset value of the per share for SIA. So with that reduced net asset per share, if they pay out the remaining MCB by this financial year, we think the share price right now at 7:30 is actually within 1.5 times price to book, which it doesn't make sense for airlines. Airlines is actually the most difficult industry to operate in. You have to keep your aircraft safe, make sure they don't lose one engine, one screw. You have to keep your air crew pretty, make them look good. So you spend a lot on maintenance, you compete. Mainly, in terms of flights, you actually compete with other airlines for landing slots. So landing slots is also something that partially you cannot control, because it's a lot of times also a G to G factor. You give me three times per week, then I give you back 3 times per week. That kind of reciprocal arrangement. So we think it's a reduced and the target price is 680 after you collect your 28 cents dividend, which is maybe in a few weeks time. Yeah. I'll move on to the next one, the sets. Yeah. Okay. We'll see tourist arrivals number just now, right? And all the bullish numbers. But if you delve deeper into the tourist arrivals number, a lot of them come from short haul routes like Indonesia, India, all this. SETS accounts for 80 to 85% of the flights in and throughput through Changi Airport. That means they take care of the packages, they take care of the passengers' food and so on. But because if they are short haul routes, right? If they are short haul routes, the problem right now is that there's this thing called double catering. That means if you fly Thai Airways, right? If you fly Thai Airways, you fly from Bangkok back Singapore, then Singapore back to Thailand, right? They take the food all the way from Bangkok. That means when you fly Bangkok to Singapore, maybe you eat fried tom yum bee hoon, right? But the route that you fly back to Singapore to Bangkok, it turns into tom yum soup already. It's the same food that sits in the heater, and then because it's the same day turnaround, so the food, all the food will all be catered out from Bangkok. The Singapore will not be able to supply any food. So therefore, SETS will lose this kind of double catering. SETS will lose the income from this kind of short haul routes. So when I see the number of short haul routes go up, it's really not so happy for SETS in that sense. Sorry, I'm not sure whether you catch the joke, but yeah. Okay. Just make sure you want to eat anything out from Singapore, maybe no, not so good. Don't taste so good if it's not a Singapore Airlines flight. Yeah. So, but for the year to date, May, these are the passenger numbers, air freight, and the number of commercial aircraft. Because Changi Airport accounts for 80 to 85% of SETS business. So these are numbers that we monitor, and you can tell that year to date May, the numbers is actually slowed down. Has already slowed down, especially for the cargo, the air freight tonnage. Okay. So for that, we have a neutral call on SETS. And the most important thing is from this quarter onwards, which the analysts, for us, we are getting a bit nervous because they are going to consolidate the earnings from WFS, the cargo business that they just acquired. So the consolidation might give them a bigger debt burden. On top of that, cargo, as we can tell, cargo is not a great business to be in right now. So I think the timing of the acquisition was a bit not so ideal for them. Yeah. Thanks. I'll pass on to Mel. Mel will talk about CISO.
Thank you, Peggy. I'm Mel, a REIT analyst. So we initiated SESA last month with a buy recommendation and target price of $0.9. SESA is a retail REIT with all assets in China. And they are mainly doing the outlet mall, and it's also one of the biggest player in the outlet mall industry. SESA also have agreement with tenants about the selling price. So for the in-season product, it's at least 10% discounted to the original price. And for the out-season product, it's around 20 to 30% discounted. We would like to highlight 2 investment merits of the REIT. Firstly is a stable income base. So backed by a very strong sponsor, SESA has implemented the EMA rental income model. It basically consists of 2 parts. the fixed component with 3% annual rental escalation, and the variable component pegged to the tenant sales. So FY22 wasn't a good year, as where everyone knows. China was majority of the days was in lockdown, and other days was the outbreak of the pandemic. However, SESA was still able to generate sufficient DPU, and 70% of the revenue were contributed by the fixed component. And this year, the fixed component alone, we expected to generate around 6% of the dividend, and which is more than the average of the STI stocks. Secondly, SESA is able to capture the upside through the variable component of the EMA rental income. In FY23, the first quarter, tenant sales already up 17.9% year-on-year due to the pent-up demand and successful promotional events. We also observe a trend of shifting consumer preferences towards becoming more budget conscious. And there's also a growing number of middle-income families in China. And we believe the outlet mall concept will be more favored by the Chinese consumers post-pandemic. Pre-pandemic, the tenant sales were already growing at 12% year-on-year. And with the normalization post-COVID and the pickup in consumption, we believe the tenant sales this year is able to increase by 25%, which translates into 10% of the dividend yield. Yeah, that's all for SESA. I'll hand over back to Paul.
Thanks, Mama. So we're just going to do a quick conclusion before we move on to Q&A. So for us, the conclusion, we just think that the high inflation means high interest rates and global growth will still be weak. We like hospitality and even China, although we don't have a slide on it, but implicitly, because we like capital and investments, and we even initiated on a REIT to try and capture China consumer. That's why we think that will be better, and hopefully there's a stimulus. We all keep fingers crossed in China. Singapore economy is still in stable shape, and for us, you see that we are gravitating a lot to dividends, just to shelter out, because we are just very concerned of the whole economic environment, which is kind of deteriorating. So with that, I think we can move on to Q&A. I'll hand it over to Roshan.